Welcome back to the Global Ledger. I'm Justin. Today's episode is a turning point in the entire series because when people talk about inflation, they talk about it as if it were a political event or even a psychological event or even purely an economic event. But I would say inflation is first and foremost a balance sheet event. So it is the result of how assets and liabilities expand, how credit is created, how collateral values shape credit growth. This episode will walk you through how inflation actually starts, how it spreads through these balance sheets, and why some inflation spiral and others don't, and ultimately how the Fed, the Treasury, the banks, and even the shadow banks, they all interact. So let's get started. So most people think that inflation begins with the money supply, maybe even government spending, or one I hear all the time is central bank printing. But in the modern system, inflation begins with something a little bit more simple, and that is balance sheets expanding faster than the economy's ability to produce goods and services. So this can happen through bank lending, shadow bank lending, fiscal deficits funded by markets, and so on and so forth. There's a lot of things that can do this. Inflation is not too much money. It's too much balance sheet relative to real capacity. So I want to talk about two engines that we call it the two engines of inflation. So and they often overlap but they are distinct. So engine one, of course, the banking system. Okay, this would be deposit money plus credit creation. So when banks expand lending aggressively, deposits grow, purchasing power rises, demand can exceed supply, and prices can start to drift upward. So this is classic demand pull inflation, but understand mechanically through balance sheets, understood mechanically through balance sheets. So engine number two would be the shadow banking system. This is clearly collateral-driven money. So and probably the most and probably the less understood engine. So when collateral values rise, haircuts shrink, and leverage starts to expand, and repo funding becomes more abundant. So we get what's called a shadow credit boom. This doesn't create deposits directly, and we've talked about this in prior episodes, but it creates funding capacity. So which boosts asset prices, which boosts wealth effects, of course, and which increases spending. So this is inflation driven by market balance sheets, not banks. So let's talk about why fiscal inflation feels different. So this is where we bring in the Treasury. So when the government deficit spends, households receive deposits, banks receive reserves, and markets receive treasuries. So in the old world, this was purely government spending. I would say more of a synchronized expansion of balance sheets. The Treasury issues new liabilities, bonds. The banking system expands deposits and reserves, and repo and collateral chains grow. So that's why large fiscal expansions can create more demand, bigger collateral pools, lower haircuts, and therefore inflation. So easier funding conditions. So not because money is printed, but because balance sheets widen across the system. If we look at let's actually map inflation onto the hierarchy here. So with the Fed at the top, sets the price of reserves, influences funding spreads, stabilizes or destabilizes risk taking indirectly. So then we go to the middle. So banks plus dealers expand credit, fund assets and repo, create deposits, transform collateral into liquidity, and then we go to the bottom, which is the real economy. Receives deposits, credit, liquidity, increases spending, reacts via supply and demand. So inflation emerges when that middle layer expands too quickly for the bottom layer to absorb. Maybe we should talk about asset inflation versus consumer inflation. So there's two kinds. So asset price inflation would be driven by repo liquidity, collateral booms, low volatility, what else? Easy funding, higher dealer balance sheet capacity as well. So this is the world of, call it QE-driven bull markets. So tight credit spreads and rising valuations. That would be kind of the first type. The second kind, we can call consumer price inflation. So this is driven by fiscal injections, supply constraints, higher wage costs, physical bottleneck. Asset inflation can last for years. But consumer inflation hits faster and forces policy shifts. But behind both lies the same root, and that is balance sheet expansion outpacing real capacity. So how inflation, how it ends? This is an important question. So let's look at this in balance sheet terms. So inflation ends when funding costs rise. Okay, think repo, credit spreads, and hedging costs increase. Number two, dealer balance sheets contract. So this is when the dealer's less willing to make markets. Number three, we could throw in bank lending standards tighten. So credit creation starts to slow. Number four, fiscal impulses start to fade, so less net new deposits. Households start to delever, would be number five, so demand falls. And number six, the Fed raises the price of liquidity, so risk premiums across the board. This is textbook. The Fed raises rates. So funding channels contract, credit slows, balance sheets shrink, and inflation recedes. Let's try to link all this up with valuation. Always like to end the episode with linking what we're talking about with the capital market, valuations, corporate finance, or finance in general. Inflation influences valuation, and this is through higher discount rates, lower margins. Think when we think higher discount rates, we're talking about the risk-free rate going up, risk premiums going up, funding spreads going up. This is going to ultimately cause valuations to fall. Lower margins, of course, higher costs, lower operating leverage, uncertainty. Call it uncertainty premium. We could call it. This is markets price in more volatility, and maybe a last one. capital allocation shifts, so debt becomes more expensive. Equity risk premiums widen. So inflation is not only a macro variable; it's a valuation variable because inflation is a funding variable. Always like to reiterate and try to see the world from a different view. And this is why understanding balance sheet and understanding inflation through balance sheet might help remove some of the underlying fear that's inherent in the word inflation, especially lately. It becomes terrifying. You don't understand its origins. You think it's driven by politics, or you think it spirals just at random. But when you see it through balance sheet expansion and collateral cycles and funding conditions, it stops feeling mysterious. So inflation becomes a phenomenon when you can track, measure, and understand systematically. And that's the purpose of this show. So I want to thank you for listening to episode 18 of the Global Ledger. We reframed inflation from call it political debate to more of a balance sheet point of view. In episode 19, we're going to go deeper into the mechanics of funding. And that's the price of leverage. So how funding costs shape market cycles. So this is where we connect volatility, margin, financing costs, and market structure into one story. So once again, I'm Justin, and thanks for being here.